Ever wondered why bond prices and interest rates move in opposite directions? It's like a well-choreographed dance where each performer knows exactly when and how to move. Let's break it down. Interest rates play a leading role in this performance. Picture this. A government or central bank decides to raise interest rates. The new bonds issued on this elevated stage come with higher coupon rates, the fixed interest payment expressed as a percentage of the bond's face value. These new bonds are like the fresh faces at a party, grabbing all the attention. The older bonds, however, with their lower coupon rates, suddenly find themselves less attractive. They're offering lower returns compared to the new bonds, and who wouldn't want more returns for their investments, right? So when interest rates... But why does this happen? It's all about opportunity cost. You see, bonds are unique in that they pay a fixed interest rate. When interest rates in the broader economy rise, new bonds come into the market offering higher yields. These new bonds become the belle of the ball, luring investors with their attractive returns. This creates a sort of competition, a financial tug-of-war, if you will. Investors always on the lookout for the best returns are drawn to these new bonds, leaving existing bonds with lower yields in the dust. This shift in preference isn't without consequence. It puts downward pressure on the prices of existing bonds, causing them to drop. So, in essence, the opportunity cost of holding on to lower-yield bonds increases as interest rates rise. The end result? So, rising interest rates mean there are better opportunities elsewhere, making existing bonds less desirable. But there's more to the story. Market dynamics also play a role. You see, bond prices aren't just influenced by the opportunity cost of holding bonds. They're also swayed by the supply and demand dynamics in the market. When interest rates rise, new bonds strut onto the stage bearing higher yields. This makes the existing bonds with lower yields seem less appealing, causing a dip in their demand. As a result, the prices of these existing bonds take a tumble to attract buyers. On the other hand, when interest rates fall, the spotlight shines on existing bonds. Their higher yields suddenly become more attractive, causing an increase in demand. And you guessed it, this increased demand causes their prices to rise. In essence, the relationship between bond prices and interest rates is complex, driven by changes in opportunity cost and market dynamics. When one moves up, the other tends to twirl down, and vice versa.